Thank you all for being here. I'm very glad to see you. It's an exciting night for the Baker School of Business. This is a great event. We've got a great turnout, and this is just another in our financial speaker series hosted by PermCap and John Regan. He's been a great advocate for the business school, and we're very grateful for all that PermCap has done for the School of Business and bringing Bill Ackman here tonight. As I looked at, I did a little research on Bill tonight, and there were a couple of themes that emerged as I looked there. And one of those was that consistently he's known as being an advocate for transformational change in a lot of different areas. And I think it's especially appropriate that we have Bill Ackman here, because at the Citadel we are all about transformational change. That change, that character development that builds on our core values year after year in that 4-year cadet experience. We have a lot of cadets in the audience. We're grateful for that. Build on our legacy of honor, duty, and respect. If this screen wasn't here, you'd see honor, duty, and respect on the walls up there. And that transformational change is something that we strive for every single day in this character development process that we call the Citadel experience. As we develop those leaders of principle, that's what our mission is, to develop leaders of principle, and we are excited about that. And one of the other things that I saw that has emerged about Bill, he recently said that evil fears strong leadership. And that is what we're all about here at the Citadel. We're about developing strong leaders for the next generation. We're proud to showcase our cadets and our other students that are here, as well as our alumni. The Citadel for over 175 years has striven to develop strong leaders for our nation and beyond. So without further ado, I'm going to turn it over to John and welcome Bill Ackman. Thank you.
I want to thank Dean Weeks and the Citadel Foundation Board for allowing us to continue with this speaker series. A big thank you to Joy Law in the Dean's office, and to also Bill's office to arrange this. And Bill, thank you so much for taking your time. Time is the most precious commodity. You're spending it with us tonight, and I really appreciate the support. And also thank you to Trey Hamilton for giving us a great tour of the airbase today. And I'm sure it's going to be a very interesting evening. Our business partner, Joe Steinberg, says very often when we start any meeting, why are we here? We ask that, and the answer is that I moved my family and my business down here during COVID in 2021. I was very lucky to connect with Sam Havelock and Trey Hamilton, who quickly drafted me into the board of advisors here. Although I'm not an alumnus of the Citadel, I wanted to contribute my resources to this institution in honor of the two guys and the many others in the room who have spent their careers serving the country. The speaker series was designed to bring world-class financial leaders to the Citadel. I think we've done that tonight. And to show the cadets how to illuminate the path to institutional finance and Wall Street. We do this by connecting the business community to the cadets at these events, and we source internships for them. We've been very successful over the last 2 years in sourcing internships for pretty much anyone who wanted one. And this is, I can tell you that if you're here and you're not wearing a cadet outfit, this is a great place to recruit employees. And the employees know how to show up on time, properly dressed, and they're properly educated. So nothing in life is free. So if you're here tonight and you would like a guaranteed seat in front, next time, contact the QR code that's there, which maybe as it gets a little darker, you'll be able to pull it down, and contact us directly with your offer of internships for our cadets. Why is Bill here? So now I've explained why we're here. Why is Bill here? The other founding partner of PermCap is Joe Steinberg. Joe is now the chairman of the investment bank Jefferies. And he was also, little known, long ago at a company called Lucadia, the seed capital for Pershing Square. Joe was also the seed and partner for PermCap, my firm. So we are both, in a way, part of the Joe Steinberg family tree. We share investments together, we share deals together, and we also share the occasional dive trip together. If you ever want to feel lazy and unaccomplished, spend a few hours with Bill Ackman on his plane. I've personally seen Bill deftly handle an interview with an aggressive Wall Street Journal reporter, switch to an extended board meeting, and then simultaneously launch a Twitter attack about excessive expenses charged to a nonprofit, all before lunch was served. He has focused big ideas, he has solutions for big problems, and he always wants to do the right thing. He retains a sense of urgency in everything he does, and that urgency and energy stays with you after you're with him for a while, and it makes you want to clear a higher bar in everything you do. Like all great athletes and leaders, he makes everyone around him better. I've seen it, you feel it after you talk to him. Bill is the CEO of Pershing Square Capital Management, which he founded in 2003. He's a member of the board of Universal Music Group. He serves as a member of the Investor Advisory Committee on Financial Markets for the Federal Reserve Bank in New York, and as a member of the Board of Deans of Advisors at Harvard Business School. He takes his philanthropy as serious as his business and his tennis. Bill is the co-trustee of Pershing Square Foundation, which is part of Pershing Square Philanthropies, which bets on innovative leaders solving humanity's big societal problems. Please welcome Bill to the Citadel. We had a script, we had a slideshow, and pretty much Bill threw it away. And he said, ask me any question. So we'll start with that as a rough outline for the evening. What we like to do in the early part of these things is to take you back to the beginning. And I'd like you to talk, that's a picture of you and Whitney up there. I'd like you to talk about your $2,000 bet with your father and your SAT scores.
Okay, so I was a risk taker. And my parents didn't believe in allowance, so I became an entrepreneur pretty early on, and I'd saved up about $2,000 by the time I was going to take my SATs, and I told my dad I was going to get an 800 on the verbal and probably an 800 on the math. And he says, okay, well, how much do you want to bet? And I said, okay, well, let me just see how much I have in the bank. I said, okay, $2,000. He said, okay. This was a week before the SATs. On the Friday before the SATs, my dad got a bit nervous and he withdrew the bet. True story. So then I went into the investment business.
So you were going all in from the age of 17?
Yeah, for sure.
Okay, so the most important thing we can impart tonight.
$2,000 was a lot of money when I was 1983.
The cadets, what would you advise the young cadets in school today who are coming out? How should they be preparing right now to get onto Wall Street or get into the job market?
So one of the things I say to when I talk at business schools and colleges, and I go to a lot of great schools, is the speech I give or the advice I give is that if you're here, you're unprepared for what's coming. And the reason for that is most of the places where I speak, you have students who did really well in high school, did well in their SATs, they got into a really good college, they did really well there, they got a job for a couple of years, they did well in their job, now they're at Harvard Business School, they're about to graduate. And I said, the problem is that if you're here, you've had no experience with the most important thing that you need to understand in order to be successful. You've had no experience with failure, and you're going to fail. It's going to happen. And life is like that. And you might get fired from your first job, your first startup. You may not be able to raise the second round. You could fail personally. You could have challenges in your personal life. Your partner, your girlfriend could have some challenge that takes you offline. And every successful person I know has their key to success was how they dealt with failure. And I think what's interesting about this place is I think they try to teach that while you're here. And it's one of the few schools I've spoken at. My biggest piece of advice is that be prepared for the unknown, be prepared for the uncertain, be prepared because you're going to fail, you're going to go bankrupt, something. But the great thing about this country is that there's always a second act. And actually, people like betting on people that have failed. If I look at my trajectory, it was not a straight line up. I've had significant moments of major setbacks in business and personal life and otherwise. And I just, I think the most meaningful part of my college education was I rode crew. And maybe it's something like the equivalent of some of the challenges you deal here, but you learn to deal with a lot of pain, a lot of adversity, and you make it through. And as long as you believe that, if you find yourself in a deep, dark hole, you just power through one day at a time. And this thing they teach you in business school about compounding and the laws of, the power of compounding, it applies to saving yourself from challenges, meaning just make a little bit of progress every day. You won't notice the progress for the first 30 days. 90 days in, you're starting to notice the curve is starting to move. 6 months in, you've made huge progress. Don't look at where you fell from. Don't look at the startup that had a $300 million valuation where you raised money and now you're starting all over again because the original idea didn't work. Don't focus on the 300. Focus on where you are. Focus on the next step. Make a little progress every day, and it works every time. And the never give up thing is entirely true. And I'm a good example of that. So I've made bigger mistakes in the investment business than almost anyone. I lost $4 billion on one investment. And it's a big number. And despite that, all of my investors who stayed with me over time have done extremely well. It's been a 16% compounded return for 20 years at Pershing Square, but it wasn't a straight line up. There was a moment where we were down 35% in 2017 from the peak. Investors were redeeming capital. I was going through a divorce. I had a litigation in connection with one of my investments. It was a really sort of grim moment. And, I took my own advice, made a little progress every day, used good judgment. And I'm way better off today having gone through that sort of moment. Our firm is, one of the important things about the investment business. The problem with the investment business, if you're a long-term investor, is investors generally give you money over a relatively short period of time, and you're trying to generate value over a long period of time. And there's this mismatch, and people talk about the asset liability mismatch problems. You have a bank where you're taking deposits, you're making longer-term loans, that creates risk. The same thing's true in the investment business. So my ambition was always to get to a place where the capital was permanent, where it would never leave. And the path by which I got there, it was that failure that created the opportunity to create permanent capital. And that's been a huge advantage for us. So look at every challenge as an opportunity. The good always comes from the bad. You just have to look for it.
That podcast, I've sent that reel with Friedman, that interview that you did about the little steps, and I sent that to both of my kids. And we played, and I keep sending it to them. Every time it pops up on my Instagram, I repeatedly send it to my son and daughter. I was going to try to figure out how to tempt you into doing it, but you did exactly that podcast of the little steps of compounding. Nutrition, sports, health, maintain your health first.
Yeah, actually, I'll tell that part of the story. Yeah, so I'm also a huge believer that you can't make it through a challenge unless you're physically, mentally healthy. So, good sleep. Weightlifting is actually, this is a good audience to talk to, it's good for your muscles. It's also really good for your brain. And nutrition. I don't know, I haven't checked out the food here, but I'm kind of a believer that this seed oil thing is not good for you. I went 0 sugar beginning in November. It's been amazing. I recommend you do that as early as possible. Sugar is poison, and the sooner you give it up, the withdrawals, like a couple of weeks without heroin, I think. But once you're through the withdrawal, it's kind of a life-changing thing. So nutrition, sleep, exercise, some sun, and you can get through anything.
This is a slide of the mere 45x return of Pershing Square since inception. Do you want to explain the best investment, worst investment?
Actually, the thing I'll point out here, you see if the line sort of gradually goes up, that's a 21% compounded return for the first dozen years. And then there's like a relatively small decline. That relatively small decline is down 35%. And at the time, it felt momentous. But the beauty of compounding with the passage of time is you look back, that doesn't look that meaningful, right? So that's the thing that you have to remember. The challenge you're feeling feels monumental. The business loss, the money loss, maybe you got sued, maybe you lost a lawsuit, a divorce. You have a health issue. It feels just like your life's over. It's how successful people, it's how you deal with the challenge, how you deal with the failure that determines your success. It's less about the success. It's more about the inevitable challenge and making it through it. And a lot of people, just sort of veer off and give up at that moment. If you don't, it works. Yeah.
Let's talk a little bit about your path, your very, very short path to a hedge fund immediately from undergraduate.
Business school.
From business school. You found your way to Joe Steinberg. Look at you. Joe made one of the worst investment decisions of his career by not taking the full stake in Pershing for later on. But talk a little bit about the path that took you to Gotham and then to Pershing.
Sure. So I went to business school to learn how to be a good investor. And the first investment lesson was to read the course catalog before going to business school. I went to Harvard Business School to learn about investing. I get there, there was a thing called a course catalog. You guys don't know what that is, but it was like little books. It had a list of classes in it. And I literally, first day, I pick up the book, and there's not a class on investing. And I'd already committed $40,000, which is what it cost to go for a year at Harvard, including housing. So I learned the first lesson in investing is you do due diligence before you pay, right? Very powerful lesson. And then what I did is I opened up a Fidelity brokerage account. I had $40,000. My parents were paying for my education, which is an enormous advantage in life. I had $40,000 in savings. I said, look, this is my tuition in the investment business. If I lose it all, it's another year at Harvard Business School, but I'm going to pay a lot better attention in class if I have some money at risk. And I designed my own investment program, which was, accounting, finance, competitive strategy with Michael Porter. And then I started investing, and a classmate of mine, it was kind of lonely. It was an investment club of one. There was no investment club, believe it or not, at Harvard back in 1990. And so we created an investment club of the two of us. We started looking at companies together, reading annual reports, and it was fun. And then by the second year, I said, imagine if we could do this and people would pay us to do this. Right? That's how you know you've found your career. If you find something that you're excited about doing, even if you're not paid to do it, that's what you should do. And then actually, if you can pick one of those things where the pay is good, obviously, even better. And then I said, well, why don't we just start an investment firm? And there was a guy named Seth Klarman who had graduated 10 years before us, who ran a firm called Baupost Group. And he was hired by a group of faculty that a very number of wealthy families were looking to create or to invest in an investment firm, find a firm like John's, for example, and they couldn't find one. And they hired this HBS graduate to kind of do some due diligence on who would be a good firm, who would be good to invest with. And they turned out they were more impressed with him than were any of the firms they met with, and they backed him in launching a hedge fund right out of Harvard Business School. And I figured, okay, he did it, and we could too. And I figured the worst case is I would get a job, right? All my classmates were getting jobs. And I figured if I did this for a couple of years and it didn't work, that's what they call, experience is making mistakes and learning from them. So I've had a lot of experience. And if it worked, it would work. And that's how I started. And then I raised $3 million, which took a few months, but it was enough. Wasn't married, my business partner and I shared an apartment, and that's how we kept the costs low.
The first big ditch where you were discovering mortgage insurers, take us through that scenario. And most people, I think even some of the guys I work with can't even remember back, but like you were being investigated by Elliott Spitzer, sued by the mortgage insurers.
Not sued, but yes. I mean, they didn't like us.
Pilloried in the press by these people, and they're chasing you out of town. But you're right, but you're very early. Take us through that, and then how that then transitioned into Pershing.
Sure. So Gotham Partners, my first investment firm, the vast majority of our investments were we'd find companies we liked, we invested in them, they would grow in value. We'd look for companies where we could help make them, they were underperforming or undervalued because they were making sort of bad decisions. And we'd buy a stake and help them make better decisions, so-called shareholder activism. We came across a company called MBIA, Municipal Bond Insurance Association, and it was a guarantor of muni bonds. So they would put their credit wrap on small, medium, and large credit issuances of states and municipalities. And a friend had recommended it as a long investment, a stock that you should buy. And as I was reading the letter from the CEO, it was a very strange letter. And it made me kind of go deeper. And the more I read about this company, the more I concluded that this is not actually a good investment, this is potentially a totally fraudulent company. They had a AAA rating, they had $1 trillion worth of liabilities, and they had $5 billion of capital, pennies, literally pennies, supporting these obligations. And the whole premise was they were guaranteeing bonds that would never default. But with that AAA rating, over time, they started guaranteeing much riskier things. And by the time I was looking at the company, they were guaranteeing subprime mortgages and so-called CDOs and synthetic CDOs, these very complicated instruments. And it just led me down a rabbit hole, and I concluded that this AAA company was basically insolvent and that it would go bust the moment there was any stress in the housing market. And so there was an instrument invented a year or two earlier called a credit default swap, which is basically like an insurance policy you can buy on a company. And the insurance policy pays off if the company goes bankrupt. And the insurance policy trades every day, and there's a market for it. And because the company had a AAA rating, the insurance on the company defaulting was was nothing, paid very little for it. So this is an incredible investment. And so we bought, well over $1 billion of this insurance policy, and it cost us, 0.23% of the total value of the policy. But the problem is that no one knew what we knew. And so I talked to our lawyers, and I said, look, how do I get the word out on this company? And they said, look, write everything down, write a little white paper. We'll make sure we've got footnotes for every fact we allege, and we'll have all the proper disclaimers. And then you just put it out there, and free speech, and the world can decide. And so I did, in fact, this. And then actually Joe Steinberg, who John referenced before, invested. We set up a separate entity, separate partnership, just to buy more of this insurance. For $20 million, we could have, if the company went bust, we made $1.5 billion. That sounded kind of exciting. And then we put out a little white paper. It was a 66-page white paper entitled, Is MBIA AAA? And then the turd hit the wind-generating device. And basically, I pricked the bear. And the bear here was the largest guarantor of New York State and city bonds. And they knew every, governor, state treasurer. They were an incredibly influential company. And so they called the treasurer of the state of New York, and they said, look, there's this evil hedge fund guy. He's claiming that we don't deserve our AAA rating, and Moody's, S&P, and Fitch say we're AAA, and he has an investment on which he'll profit if, it's market manipulation. And that was really the beginning of this incredible sort of life experience where they went after me very aggressively in the media. Eliot Spitzer launched an investigation. He was like this, the toughest attorney general ever. And that's my first real, you call it a ditch. It seemed like a very deep mine. That's the best way I would describe it. And that was my first challenge. I was investigated for 6 or 7, it's actually not even clear how long, but I had 6 or 7 interviews with they requested every document. It was like 186,000 pages of due diligence I had underlined on the company. If you can imagine how much reading I did here. And then I had to explain to a group of lawyers who knew nothing about finance what a credit default swap was, the accounting for these instruments, why it was wrong. And my lawyer said, look, just try to keep the answer short, and kind of like this answer. So, 7 days of on-the-record testimony with the Attorney General. Then the SEC didn't want to fall behind Spitzer. They launched their own investigation. And it was like a moment in my life. And I had to wind up my fund because I couldn't, while this was going on, we had to kind of push pause. But I just believed in free speech. I knew I was right. They just tried to find something wrong with my white paper, and there was nothing wrong. And at a certain point, my favorite moment with the SEC, and all these transcripts, by the way, are public. At a point, they said, well, Mr. Ackman, you seem to be implying that we should be investigating MBIA instead of you. I said, yes. Yes. And they didn't. This was 2003. And then in 2007, the financial crisis, the first companies to blow up in the financial crisis were the bond insurers. And basically, after Spitzer's investigation, one of the things that's really remarkable about Joe Steinberg, who we mentioned, I was tarnished in the press. When the government investigates you and they find nothing wrong, they don't write you like an apology note that you can show mom, see, mom, I did nothing wrong. they just disappear and they go quiet. And I wanted to go back into the business. I wanted to launch a new firm. And I'll tell you a small little anecdote that John doesn't know. So my wife and I, my then wife, I've been remarried since, she and I went away just to get away from all this bad press and everything else. And we went to Cabo San Lucas and went to this beautiful little resort. And we got there early, and we just went there for peace, just to get away from all the press and everything else. And we check into the hotel, and they're like, your room's not ready. You can wait down by the pool. We go down by the pool, and I kind of walk in my New York City clothes. Everyone else is, it's just this beautiful scene. And this guy gets up seeing me. He says, Ackman, what the fuck is going on? And it's a guy named Ian Cumming, and it's Joe Steinberg's partner. He's there with a bunch of friends. And he says, Bill, we need to talk. And we sit down and we have lunch, and I tell him the whole story. And he says, you know what, Bill? When this smoke clears, let us know. Joe and I want to back you in a significant way in your next, whatever your next thing is, which is an amazing thing for someone to say. And it took me about 10 months to work through all this stuff. And I launched Pershing Square, and they put $50 million in. And they were, very reputation, amazing firm. And with that and a little money I scraped together, I started Pershing Square. But it's kind of a good example that you can come back from. It was pretty, grim. So,
But best investment.
best investment. Why don't we just talk about the bad ones? Oh, no, the good news is, by the way, MBIA eventually, I rebuilt the position, and then it blew up in the financial crisis. And I made, $1.5 billion for our investors on like a $30 million investment. And so it was a good end of the story. And there's a book about it called Confidence Game, if you ever...
We did use the slides.
Okay, there's the book. It's out of print. It's such a popular book. Best investment. So the best, I would say so that was one of the best investments. The best investments are generally ones where everyone else thinks you're wrong, right? So we had this company where everyone believed it was the most creditworthy company in the world. It was as good as the federal government, AAA rated. And actually the federal government today is not even AAA rated. It's like AA plus or something. And we bet that a company with a AAA rating was going to go bankrupt, and we made 35, 40 times our money. The inverse of that is in November of 2008, a shopping mall company called General Growth, second largest shopping mall company in the country. The stock went from $63 a share to 34 cents in like 6 months. And the reason why the stock went down 99.5% was they had a lot of debt. They borrowed money in the CMBS market, which is the securitized real estate market. And that market shut down during the financial crisis. And everyone said they're going to go bankrupt because they can't pay off their debts as they come due. They had $27 billion of debt, about $15 billion coming due in the next 18 months. And the stock went from like a $6 billion market cap to a $100 million market cap. And my bet was, the malls had gone from 93% occupancy in 2007 to 95% occupancy in 2008. So the occupancies were up, the rents were up, the net operating income was up. The fundamentals of the company were solid. And these were basically Class A, sort of the fanciest, best malls. And so the assets were fine. And before this company, everyone who had invested in a company that had gone bankrupt, the shareholders had lost all their money. But I didn't understand why that had to be the case. I read, a book on bankruptcy. I called our lawyers. I'm like, look, I think the assets are worth more than the liabilities. Why shouldn't the shareholders be able to make a meaningful recovery? And they said, look, it can happen, but it never does. Because what happens when a company gets delisted and goes bankrupt is people sell the stock, distressed investors buy the debt at a discount, and then they work the process through the courts and end up keeping 100% of the company. So I said, well, we're going to do something different. We bought 25% of the company in the market for $60 million, starting at 34 cents a share. I joined the board, and then I helped the board run a process that benefited not just the creditors, but also the shareholders. And the stock went from 34 cents to ultimately $31 a share. But it was, so again, the most contrarian investment you can make buying something is to buy stock in a company going bankrupt, right? Because everyone says it has to go to zero. And if you do a little bit of work, a lot of work, and have an insight, those are the best examples.
You've absolutely changed your style over the years. You used to be an aggressive activist.
I'm always aggressive.
Always aggressive.
Why not be aggressive? Is everyone here aggressive? I assume you're aggressive. You go to this place. You want to be aggressive. You're either aggressive or you're weak. Which do you prefer?
You don't publicly short companies anymore,
We don't short stocks. Big mistake, don't short stocks.
and you've achieved a measure of permanent capital in the last few years, which is very important to Pershing Square.
Yes.
How has that changed your risk tolerance? How has that changed your risk parameters?
So I would say our risk parameters haven't changed, but what's changed is when I first went into this business, no one knew who we were, and we were telling kind of big public companies that we had a better way for them to run their business or structure their business than they did. And the idea was, how could someone outside of McDonald's or Wendy's, some of our early investments, have a better insight to how our company should be run or structured if you don't even work here? And so the early days of shareholder activism, companies really pushed back on shareholders who had ideas. But we had some big early successes. Shareholders did really well. You build what I call reputational equity over time. When I started Pershing, I was 37. Today, I'm 58. I'm basically the age of most. I'm sort of one person removed from, or one or two people removed from every CEO in America. I've been on many public boards, built a reputation. People can kind of check me out by talking to CEOs that we work with. And the advice they give is, you know what, you should hear what he has to say. And so we haven't had to barge our way into the boardroom. Today we get invited in, and we can do what we do without having to run a proxy contest. So that's what's changed. It's not really a change in risk. It's a change in sort of the maturation of the firms.
Switching gears a little bit to more current events, because you said we could throw away the script.
You can ask me anything.
Tariffs. We have interesting.
What's a tariff?
The last guy who sat here is in charge of that effort.
I think in charge is not entirely accurate.
Helping.
Yeah.
How do you think this is all going to work out? Is this a negotiation or is this trade war?
So I think a tariff is a tool that can be used to accomplish certain objectives. And I think the president's objectives are important. So one, we have unfair trading relationships with various countries around the world where they charge a higher tariff on our goods than we charge on theirs, or they have other practices that make it very difficult for U.S. products to enter their market. President Trump is America first. He doesn't like the country being taken advantage of, and he wants to fix those arrangements. So that's one way you can use a tariff. What I thought most of his effort would be is so-called reciprocal tariffs. You're charging us 10%, we're charging you nothing. You know what, we're going to charge you 10, and if you don't like that, if you'll take yours to 5, we'll take ours to 5, and we'll use the tariff as a way to kind of create fair trading relationships. That's one important potential use of a tariff. Another one is, the world has become, I would say, riskier geopolitically and otherwise. And we learned in COVID that relying on other countries for PPE or the ingredients that make pharmaceuticals is potentially threatening to the United States. So we have to be able to make certain product here that's important for the defense of our country, that's important for the health of our citizens, and relying on semiconductor production on an island off of China, that seems like a bit of a risky proposition. So we got to bring that activity here. TCMC, you're amazing at what you do, but if you want us to buy from you, we need you to build the plant here. And so another way to use tariffs is to say, hey, we're going to put very big tariffs on these important strategic assets that we need in America, and that works to bring that sort of activity home. And then the third thing I would say is this question of balance of trade. Here, this is where I would say I feel like the president thinks tariff is a little too beautiful a word. And what I mean by that is, when the president got up on, as he called it, Liberation Day, and he talked about reciprocal tariffs, the market went up, was up about 2% when he first talked about, the reciprocal tariffs, because people thought he was going to use them as a tactical device to lower tariffs. And then he put up that very famous chart, which calculated what was called tariffs, but really was a calculation of kind of the trade balances between the U.S. and other countries, and used that as the basis to say, okay, Vietnam is effectively charging us a 92% tariff, so we're going to make a fair deal with them and only charge them a 46% tariff. And that calculation, I think, is not one that fits into my understanding of the economic world, if you will. And it makes sense to me that the United States, as you know, it doesn't make sense, let's put it this way, that Madagascar or Lesotho is going to buy as much from us as we buy from them. That's just really the reality. We're a much bigger economy, we're a vastly bigger country. I'm giving you kind of the extreme examples, but the same thing's true for Vietnam, and the same thing's even true for South Korea and kind of otherwise. And there's, you know, we learn somewhere in the economics class, you learn about something called comparative advantage. It does not make sense to produce T-shirts and blue jeans and baseball caps generally in America. Other countries with lower cost labor, you know, it's a better place to make those kind of goods. So I think this kind of, I guess I have trouble giving short answers, but the answer here is it sort of depends on how the tariffs are being used. And the other point I would make is you can't make changes in your supply chain overnight. And you know, when the president announced tariffs at this, you know, very, very high level, my advice to the president was pause. You've gotten the world's attention. People had a real opportunity to feel like what the impact of these tariffs would be if they were instituted immediately. Let's pause. Let's give Scott time to negotiate deals with our trading partners, and let's set up, you know, so that this, you know, we can do this without disruption. The risk of what's happening now is that business people, you know, in order to be in business, you got to predict the future, right? You got to say, how much am I going to sell next quarter, next year? You got to plan for that. You know, you may have to make an addition to your factory. You have to hire workers. You have to make investments. It's hard to plan for the future if the future becomes uncertain. And what the sort of tariff, what war, to the extent it's become one, has done is create a lot of uncertainty. And uncertainty causes businesses to pause. When businesses pause, the economy gets weaker. And this community knows better than any other. If you're going to go to war, you want to be at your strongest and fittest. And that same thing's true if you're going to go to a tariff war. The United States has got to be a really strong economy, and you don't want to disrupt that economy. The other thing you do when you go to war is you want to work with your allies and you want to focus on your enemy. And I think we kind of launched a tariff war against 170, 80 countries at the same time, and vast majority of those countries are friends of the United States. And I think, you know, in retrospect, we should have focused on China. So I think, you know, we're going to get to the right place. The president has shown a willingness to adapt and make changes on the fly. And I ultimately, big believer in the country. I believe in the president and his advisors, and I think we will eventually get it right.
And China, where do you wind up? How do you negotiate that out? Because you did use the term war.
Yeah, look, when 145% tariff, it just means you've just turned off trade. You know, there are very few. I can't think of a product that a company buys from China that if the price, you know, goes up 145%, that they can pass along that cost, or they have enough margin in their business where that doesn't wipe out, you know, their business. So a lot of companies are as quickly as possible moving their supply chains to other places, but there's still, even Vietnam, which is sort of a natural place, for example, if you're making sneakers in China, Vietnam is a logical place to do that. And even the Vietnam situation is kind of uncertain. So I think it's likely that this, you know, we've had a brought forward of demand into the first quarter as businesses assumed some amount of tariffs. And so they said, look, let's ship as much as we can out of China and other places where we're expecting some kind of tariffs. So we've kind of front-loaded some demand. And I think you're going to see kind of a pause kind of going into Q2. So I think we'll be at the beginning of a recession, I think for sure, in Q2. And what keeps us from going into a deep recession is that this gets resolved, you know, fast. We start hearing about a deal with Japan, you know, soon, South Korea, India. All of a sudden the business community starts to say, okay, this is going to work. This is going to get resolved. I can start predicting the future again. I can start hiring people. I can start making commitments.
I want to ask one more question before we go to Q&A. Harvard, you're trying to help them improve themselves with sage advice. I think, you know, we both had the benefit of going to these schools that have drifted away from what their core mission was. The other night at dinner, you laid out, here's my activist plan for Harvard. This is what I was. How do you fix Harvard?
So, look, Harvard's a great place. You feel loyalty to any institution that's played a meaningful role in your life. I went there 4 years undergrad. As I mentioned, I rode varsity crew for 4 years. I went back for the business school, had a great education, made lifelong relationships, care about the place. What's happened at Harvard and actually other, so to speak, elite institutions is what I describe as almost ideological capture of the institution. And there's been a lot of discussion in this administration. I wrote a 4,000 word essay, you might call it, on Twitter on DEI in January of 2024, and I talked about how this ideology had kind of permeated Harvard, and we had an institution that was focused on meritocracy and excellence and colorblindness, I would say, and it became an institution focused on race, on gender, what some people call intersectionality, on a kind of a framework for the world where their world is divided into two groups: people who oppress other people and people who have been oppressed by other people. And this ideology kind of permeates, unfortunately, kind of the humanities at Harvard, and has affected everything from the admissions office to how faculty are selected. And the other thing that's happened is that each of the various, the government department, the economics department, et cetera, the departments kind of appoint their own faculty. Harvard did a survey a couple of years ago, an anonymous survey. 2% of the faculty identified as conservative or very conservative, and the rest of the faculty basically identified as some portion moderate. Vast majority described themselves as left or far left from a political perspective. And when a department tips 70% progressive left, the departments at Harvard tend to, maybe it's natural about how academia works, they appoint people that share similar political views. And that's what led the institution to kind of veer so far ideologically to the kind of left politically. And the problem with that is that, in my view, education, the way you learn is you get exposed to broad, diverse viewpoints. And Harvard has lost that. And the way you fix that is, I think it starts at the very top. It starts with a board of directors. My advice to Harvard was, you need to fix this, or your alums are going to stop giving money, and the federal government's going to stop funding you. And that's how it's going to get fixed. And financial pressure focuses the mind. And Harvard has a $53 billion endowment, but it's extremely illiquid. It's like 85% of the assets are in private equity, real estate, and venture capital, and I question the carrying values of those assets. A lot of them commitments, 2021 values are being used to carry a lot of venture investments that are not, I would say, today accurate. Harvard has, $6-7 billion of debt. They just had to borrow another $750 million. They rely a lot on alumni donations to fund kind of current investments. And the endowment itself is actually 10,000 smaller endowments that have very strict limits on what the money can be invested in. So Harvard's in a pretty tight, with $53 billion, the only way they can get liquidity is borrowing money. And they're setting themselves up for a problem, because if you're an alum, I wouldn't be excited about giving money to Harvard and knowing the money is going to pay debt service, So I think financial pressure will cause, and the government withdrawing $2 billion of funding, this is going to, the faculty at Harvard are going to, I think, revolt, because if you're a top scientist where none of the ideological stuff has actually affected your work, and now you're going to lose a chunk of your funding because of, the radicalization of the humanities at Harvard, it's going to cause you to question whether, I would say that the faculty should 15% of the faculty are causing 100% of the problem. And I think that's how it resolves itself.
Harvard may be able to hold out for a couple of $1 billion, but Cornell, not too far away, with only $10 billion and 70% illiquid, only really has $3 billion of liquid funds. So you withhold a couple of billion of research finance from Cornell, and you're in a tighter spot much more quickly.
Yeah, a crisis can solve a lot of problems. As I said before, good always comes from the bad.
Let's go to Q&A.
Yeah, someone just ask a question.
Go ahead.
We'll answer it.
Yep.
Take this everyone. Why is it so hard to make mechanical watch movements in the UK?
Okay, the question is, why is it hard to make mechanical watch movements in the UK? So this is a bit of an arcane question. The reason why I'm being asked is I recently took control of a watch company that's based in the UK. It's called Bremont. Bremont's well known actually in the military community, because 26% of their sales are to Navy SEALs, Special Forces, Air Force, SAS, around the world. I kind of walked into a watch store, liked the watches, wrote a note to the guys who started the company, and then ended up owning it. It happens to me sometimes. The history of watchmaking is all the innovations in watchmaking came out of actually England, because the British were the big adventurers, and they had to figure out how to track where they were in the world, and they had to come up with a mechanism to keep time. There's a very famous book called Longitude, which is about this, which is worth a read. But the Swiss were a bit like the Japanese of the U.S. auto industry. Initially, they didn't make very good cars, but eventually the Japanese really took over and made better cars than the U.S. The Swiss were sort of made cheap copies of British watches, and then eventually they became the better watchmakers. Rolex is actually a British company, but tariffs were introduced, and so they moved Rolex to Switzerland. And so watchmaking itself requires talent, and all the watchmaking schools are in Switzerland. But eventually we'll be right. So today, Bremont watches are Swiss movements assembled in the UK. So check out Bremont. Yes, please.
I watched a short documentary on Yeti about 1,000 Cats, and you and Oliver White came together, and on that Argentina fishing trip, he guided you that whole week. What did you see in him to make you decide to send him the 3 books in the mail for him to read, basically testing him to see if he read them or not? Sure. And then, those are 2 parts, I'm sorry. So when y'all went to Abaco to structure that deal, how did you structure that deal with the Bohemian government? And how did that end up?
These are by far the most obscure questions I've ever received. So there's a short documentary. It's like playing on Delta Airlines, funded by Yeti, and it's about a guy named Oliver White, who is kind of the Roger Federer of fishing. I met him when he was around 25 years old, fishing in Tierra del Fuego, Argentina, and it's kind of a funny story. I went to like a charitable type, dinner, and it was an organization that promotes entrepreneurship in South America, run by a friend of mine. And my dad, loved fishing. He was sick at the time. He couldn't go to the dinner, so I bought one of the auction prizes, which was a week at the best fly fishing lodge in Tierra del Fuego, and I went without having fly fished before. And it's the equivalent of going to the Indy 500 without a driver's license, right? And we went down there, and there were a dozen guys from Jackson, Mississippi, that for the 30 years, their dream was to go to this place. And then me and my friend, my high school friend, had never fished before, and that was kind of the setup. And I met this guy named Oliver White, and he taught me fly fishing. I'm good at picking people. I don't know exactly how to describe that. It's like a skill you kind of learn over time. But I was super impressed with this young man. Went to actually UNC, philosophy major, outdoorsy guy. And I said, look, thanks for teaching me fly fishing. If you're ever interested in learning about investing, let me know. And I'll teach you investing. And got in touch a few months later. He said, if you were serious about that, let me know. I said, yes. And so I sent him actually about 10 books. I said, read these and then call me back. And then he read them and he called me back. And I hired him, and he worked for Pershing Square in the very early days for about 18 months. Now, the problem was this guy is a real, guy who likes to live in the woods. And I moved him into New York City. And he found an apartment with a disastrous roommate on Craigslist, in the concrete jungle of Manhattan. And there was only so much he could tolerate of that. But after 18 months working at Pershing, he learned about investing, he learned about companies, and we decided to go into business together. And he went to the Bahamas, and he bought a failed hotel with me as his partner, and he turned it into one of the best fly fishing lodges in the world. And the only thing we underestimated was the hurricane risk. So it was about $1.25 million investment, and it was generating about $1 million a year in cash flow, which it did for 5 or 6 years until it disappeared in a storm. So that's what happened to the Abaco Lodge. First question like that I've ever got. In the back, yes.
Mr. Ackman, I'm Paul Meeks, who met earlier. I'm a hired hand, which means I teach finance and accounting, and I supervise the Superman's Investment Fund. for which we manage about 2 million. It might be less today because we own them, maybe yet. But I had 90 some odd students come through my 3 classes today, and I asked everybody to write a question that they could pose to you.
Okay, so I've got 90 questions I have to answer.
We have the.
I got to shorten up the answer.
So I suggest that we hit one of these cadet questions. They'll introduce themselves and ask the question. You don't need to hear me say it. And then we'll go to student, non-student, student, non-student. Is that cool with everybody?
Great. Do that.
So first of all, this is Cadet Angel, and she has a question for you.
Hello. In a world driven by short-term results, how do you maintain a long-term vision in both investing and leadership?
Sure. So what I would say is, and this is advice I give everyone here, the problem being young is that you want to get rewards as quickly as possible. Time seems to pass really, really slowly. But value is very rarely created overnight. It takes a long time. It can take decades to be created. And it's going back to my, compounding, something you really should spend a little time studying, understanding the curve of compounding, doesn't really show much progress. It's a bit like COVID, right? People didn't notice COVID in the early days of COVID compounding, but it was compounding 100% a day or some number like that. And then eventually it exploded. Once you understand the power of compounding, once you understand it takes a long time to create value, and that many people are short-term focused, one of the great competitive advantages you can have in life or as an investor is just having the long view. Because some of the best opportunities, the benefit of that opportunity doesn't show itself, for a number of years. So some people, for example, take the job that pays the highest salary coming out of the Citadel because, maybe they've got some student debt or, they're planning to get married at some point and, that extra $20,000 or $30,000 or whatever the number is the difference between them living a little nicer place versus otherwise. But what matters when you're picking a job is what does it look like over the next, 5 years, 10 years, et cetera, or what will give you the best experience that you can leverage over time to create even more value. And so I think, once you figure that out, it's not so hard to make that, to make that kind of decision. And it gets easier the more successful you are. My principal driver in life has been independence. I wanted to be independent. I wanted to be able to say whatever I wanted to say. I wanted to not be reliant on anyone else for a job. I wanted to be financially independent. And once you get to financial independence, all that stuff becomes easier. But I always kind of believed that I would be successful. I actually told my dad when I was 20, I said, Dad, I'm going to be a millionaire by 30, I'm going to be a 100 millionaire by 40, and I'm going to be a billionaire by 50. Dad laughed. And I've always been like ahead. And my of the plan, and my not that money is the measure of anything, but I thought I was a billionaire when I was 22. I just used a high discount rate to discount my future my future cash flows. And by the way, that's how you should think about it as a young person, right? The biggest advantage you have is time. You've got extra years of compounding. Here's an interesting stat. Warren Buffett, when he was 50 years old, what percentage of Warren Buffett's net worth did he create after 50? And 50 sounds old to everyone in the room. The answer is 99.5% of Buffett's net worth he created after 50 years old, and now he's 94. So anyway, think long term.
We have one in the back here.
Thank you, Paul. First of all, thanks to the Citadel for letting a bunch of us college trusted people sneak in. Thanks, John, Trey, Paul. Bill, real quick, I'll shorten it until we get back to the students, but when you had your sort of moral crusade against Herbalife 10 plus years ago, I read some documentation of being surprised at both the distribution and the recruitment of people who willing to give up their last dollar for a dream that had a very low probability of paying off. Did you see that same population during this last election? And is there some correlation of our elite institutions like academics where we are today, arts, finance, that keep missing this group of people?
So Herbalife, which is a pyramid scheme, preys on undocumented immigrants, and they sell them the American dream, and they have few other good choices, and the disclosure is obviously very misleading. So it's sort of this unique kind of circumstance. I'm not sure I completely understood your question, but a big part, getting back to the question about tariffs, I give President Trump enormous credit for working hard for people in our country that have been left behind. The focus on bringing manufacturing back to America, and by the way, there have literally been trillions of dollars of new incremental investment announced in the last very short period of time of companies opening, or committing to open and invest in the country that are going to bring more jobs back to the kind of the center of our country. But we've had massive, the nature of a world where you can get access to unlimited bandwidth at a very low cost. You can be 22 years old and raise whatever money you need to create a startup. And on your iPhone, you can reach kind of a global marketplace. That's enabled a massive, massive wealth creation where, Mark Zuckerberg can be worth $100 billion with an idea he had, dropping out of school. But if you didn't have that path and that opportunity, and you grew up in a town in middle America, and the steel mill is gone, where the auto factory is shut down, and your parents are unemployed, and people are overdosing on fentanyl, these are the people that are left behind in our country. And I give the president enormous credit for trying to, and I think successfully, bringing back more industry, more jobs for people that are left behind. So these people have been, yes, they've been missed, and they are more susceptible to scams because they're looking for a way out and they don't have a lot of other great alternatives.
We'll go to a cadet Kirk.
So once you reach the top, where do your priorities shift in life?
So my priorities really haven't changed. For my, what do I focus on? I focus on, obviously first making sure family's okay. I'm an extraordinary economically fortunate person. My family's been okay for a very long period of time. I can take care of them. I can look after them. One really important thing something that was said to me, one of the other challenges in my life is my first marriage didn't ultimately work out. My ex-wife and I realized ultimately we maybe weren't the best for each other. I probably realized it a little bit more. That's a hard thing. And I had to, have the courage, to get divorced. And I'm like a super loyal person, 3 kids, one of whom was 10 at the time. But a good friend said to me, Bill, your most important obligation to yourself is to be happy. And if you don't accomplish that, okay, it's really hard to accomplish anything else. I figured out pretty early on that one of the principal things that makes me happy is, it's going to sound a little goofy, but helping other people. So for decades, I've been helping people find a spouse, get a job, make your list of, get access to a good doctor. And what's happened with the passage of time, I have more resources, I have more connectivity, is my ability to help people has expanded, sort of significantly. So I used to think that philanthropy was a good way to help other people, and I think it's actually a pretty good way. I've given away about $850 million, but $850 million later, I have more confidence that capitalism and for-profit businesses are going to help way more people than philanthropy kind of ever will. So philanthropy is still important, but I'm really careful to use it in ways where there isn't a for-profit kind of business solution. So my priorities are, one other helpful piece of advice I got from a very good friend, the advice is you're going to die, okay? So how do you have a meaningful life? And the best way to figure that out is pretend you're dead. It's your funeral. Your best friend gets up to give your eulogy. What do you want him to say? And then work backwards, right? Live your life so that when the that day comes, your friend stands up and explains your life. You feel really good about, and for me that was, okay, I want to have the largest beneficent impact on the largest number of people. That's going to be my sort of measure of success. And so I try to do, my platform today on how to do that is, day job. It's actually a good thing to make money for other people. I think I've had an impact on the way companies are managed and governed. One of the reasons why the United States is more competitive than Japan is shareholder activism has actually made companies much more competitive, have higher margins, allocate capital more effectively. So I think my day job has made a contribution. Philanthropy, we focused on scientific research, backing talented entrepreneurs, kind of solving problems. And then my third leg to the stool is actually, Twitter. I signed up maybe 7 years ago, started tweeting periodically, and I've taken on various issues, everything from child sex trafficking on Pornhub, where I had a little campaign to shut down Visa and MasterCard that were providing, facilitating payments on Pornhub, a website where child sex traffickers were putting up videos of sex with children and then doing a rev share with Pornhub, if you can imagine, and the payments were going through Visa and MasterCard. And I figured out, I read an article about this in the New York Times, and I thought I could end this pretty quickly. And in 2 weeks, with a tweet and a 30-minute appearance on CNBC, 80% of the videos were taken down, Visa and MasterCard shut down, providing payment support to those companies. So the Twitter platform is really powerful. I had very strong views about the election. I thought, I felt strongly, we had two choices. I felt strongly that President Trump would be the better choice, an imperfect choice, but the better choice. I felt for various reasons we're heading in the wrong direction. So I tried to be helpful on the election. Some people may agree with me on that. Some people disagree with me on that. We'll never be able to do an A-B comparison on whether we would have been better off with one versus the other. So I try, with extreme good fortune comes the opportunity to be helpful to other people. And that's what I want my legacy to be. So that's what I'm working for.
Good evening. Thank you again to PermCap for putting this on. And I think Charleston really benefits from what you bring to the community. And it's amazing that we have people like Bill and Scott to come here and give their time to share, what is just invaluable knowledge and experience with the students, but also for us here. And so I've got one question in a couple of different parts, not 90 parts. The first question is, did you score 800 on the verbal?
No, I got one wrong, and I'm very fortunate my dad didn't take the bet.
A key theme you touched on, and I agree 100%, is about the ability to adapt and overcome challenges. And it was interesting, somebody mentioned about British watches. I just happened to be wearing a British watch. It was the first British watch band that developed an in-house movement in over 50 years, about 7 years before Braymont.
Roger Smith or no?
No, it's Christopher Ward, SH21. Anyway, as an aside, the reason I say this, the watch industry is a case in point about adapting to change. So the reason the Swiss watch industry is what it is today, 16th century Calvinists came in and said, we're not going to have conspicuous displays of consumption of wealth anymore. We're not going to allow gold, jewelry, and overnight the gold industry had to find a new purpose, and they repurposed by saying, okay, well, we can incorporate watches into our gold and decorations, and that's how they overcome. You talked a couple of times about the most important thing is being able to overcome those challenges. 2017 sounded like it was a particularly painful time for you, so I thought we could spend some more time talking about it, and specifically, more direct.
Okay, you gotta ask the question though. Go ahead.
More direct examples of how you cope with challenge. So is it tapping into internal reserves? Is it leaning on your network of friends? Is it?
Yeah, actually, one thing, sure. So yes, I said, sleep, nutrition, exercise. The most important thing I left off is surrounding yourself with people who love you, right? So family, very, very good friend of mine, he and I, actually it was the first time with Elliot Spitzer and the investigation and all the negative headlines and everything, almost every night we'd go for a walk. And we'd take a walk from 10 to 10:30 And we just walk to the Hudson River, walk around, walk back, and just sort of companionship and support. Hugely, hugely important. So that combined with the other stuff is how I made it through.
Paul, I think we have time for one more question.
Well, I'm happy to stay as long as you want me. So
Okay, so then the other 89 questions.
I'm kind of done. Well, we have a cadet next, right? Where is Cadet McCabe? There we go.
go ahead, ask the question. We can hear you. Oh, sure.
Your number 7.
How do you handle your emotions when you have to make a big controversial decision?
So actually, I'm an emotional person, but I'm a very unemotional person about investing. And Warren Buffett talks about what he calls temperament as being a key factor. And what's interesting is, if you think about how human beings evolved, usually it was actually a very good idea if all the other people in the village are running that way to run with them, right? Because the enemy is probably coming. But investing, usually the best thing to do when everyone is running that way is to go the other direction. So it's kind of inhuman in a way, which is why it requires a kind of a dispassion. And the reason why markets are so volatile is because when people see their 401k accounts go down, 10% in 2 days, people panic, and you're kind of biologically incentivized to do precisely the wrong thing at the wrong time. And there are two things that help. One is you should never put yourself in an investment position where the assets you have at risk, if they were to go down 50% tomorrow, you'd have to move out of your house, or it would have some meaningful effect on your kind of life. So getting yourself to a place where you're sort of independent enough that that the capital you're investing, it doesn't matter where the value of it 6 months from now, a year from now, 2 or even 3 years from now. What matters is what it's worth in 10 years, 15 years, 20 years. If you can get yourself to that place, it's easier to be sort of dispassionate. Whereas if you have 100% of your net worth invested in the market and you use borrowed money, then your emotions are probably, there's no way not to be emotional about it. So get yourself to a place where you can be dispassionate, emotional. But a lot of it is just training, getting used to the volatility. That's the best answer I can give.
I can start. Mr. Ackman, will you take one more question here on the right?
Sure. I'm not going to get home before dinner, so I'm happy to stay as long as you want me.
I just had a question about kind of the global view of the U.S. now, and can you convince Trump that we need allies, or how does this play out?
Look, I think we've done some reputational damage in the last couple of weeks, but the United States has done a lot of good over the last 250 years. And the president's actually a very charismatic person, very good at building relationships. And I think this will remain one of the best places in the world to invest. Legal system, liquidity of the markets, SEC, disclosure, all the various competitive advantages we have. There's a reason why companies list on NASDAQ and the New York Stock Exchange instead of their home markets, even when their companies completely domiciled and doing business elsewhere, because the highest valuations are achieved here. So I think we make a good deal with Japan that Japan and we are happy with, and we start knocking these things out. I think people will remember the tariff tantrum, but we will move forward. Again, it depends, but that's my expectation of what's going to happen.
Cadet Ruggieri, are you around? All right. Do you need your question? Or do you remember it?
I remember it.
There you go, please.
So how do you identify investment early on before the market catches on?
So what we do is the most important thing for us is what we call business quality. So we look for businesses that, one, we can predict what they're going to look like with a high degree of confidence over a long period of time. So the value of any financial asset is the present value of the cash the business will generate over its life. If you can't predict what the business looks like 5 years, 10 years from now, 15 years from now, you really can't figure out what it's worth. So we try to find businesses that are first predictable. And then in order for the business to be predictable, it also has to be protected from the various forces in the world. The hardest thing to do as an investor is to figure out or determine, is this a business that's going to be disrupted by two Citadel students working in a garage, or is it a business that's going to survive whatever technological changes occur, AI, et cetera? That's the hardest part about investing. But once you've found a business that meets that criteria, we sort of have a library of these kind of companies, and then we track them on a regular basis. And even the best businesses in the world, at various times, sometimes for reasons completely unrelated to the business, become available at really cheap prices, right? Every stock on the S&P went down, something like 10 or more % in the couple days after the tariff announcement. Some businesses are materially affected by tariffs, others are not. If you do sufficient work, you know the business as well, because of the volatility in markets, every once in a while, a really great company becomes available at a really cheap price. And we just wait for those moments. And so it's not like we're figuring it out before other people. It's just that we know a meaningful number of companies. When the stock prices move significantly, become a lot cheaper, we update our work. If it's still as interesting as we thought before, now available at an interesting price, we buy. There aren't that many companies that meet that description that are available at a cheap price. So the other thing we do is we just concentrate, meaning we own 10 things. Most investors own, a typical mutual fund might own 100 securities. Most investors make the mistake of owning too many things. And the reason for that is diversification protects you from ignorance, right? If you don't know what you're doing, just do a lot of things, right? Most business people know a ton about their own business and they're super concentrated in their own business. I mean, if you look through the Forbes 400, the wealthiest people in the country made their money generally in one company. They had a portfolio of one. I mean, that's an incredible degree of concentration, right? So, 10, 12 stocks is more than adequate diversification if you're investing in really high quality companies. And so the combination of concentration, kind of doing our homework and being good at, figuring out the risk of disruption has enabled us to be successul.
You added a stock today.
I added a stock today. Actually, we bought a little under 20% of Hertz. And what attracted it, so most of our investments are large cap, dominant companies with strong balance sheets, kind of long-term durable growth companies, very difficult to disrupt, and we put 10, 15% of our assets in those. Occasionally we come across an investment that we call a mispriced probabilistic investment, where there's a much bigger risk that we lose money, but there's a much larger potential for gain. And Hertz is sort of an example of that. So Hertz, basically, the story here is Hertz went bankrupt during COVID because people stopped renting cars, and the company had a fair amount of leverage. It came out of bankruptcy like General Growth, our bad, we missed it, where the equity basically remained intact. And then the management team made in retrospect, strategic decision that was a disaster, which they decided to buy 100,000 Teslas and have an EV fleet. Tesla's an amazing car. They thought the market would differentiate them from their competitors, but they underestimated a few things. One, how to keep the car, you go to a gas station, you fill up the car in 3 minutes. Well, when the guy brings the Tesla back, it takes a lot longer for the car to kind of recharge. Also, the consumer, a lot of consumers hadn't driven a Tesla before. It's a little bit different of a kind of a driving experience. People worry about running out of, power, et cetera. And so that was a problem, and they realized it, and they decided they wanted to shrink their Tesla fleet, but then Elon materially reduced the price of the Model, Y, and as a result, the residual values of Teslas went down. And Hertz's business has sort of two components. One component is they own 500,000 cars, and they finance with basically 100% financing that 500,000 cars with, these securitized loans. And the way it works is if residual values of cars go down, Hertz has to put more money into this securitization to keep it sort of meet the various kind of standards. Otherwise, the lenders can liquidate the cars, which of course would be a disaster for the company. So when the residual value of Teslas went down, they had to borrow a lot of money in the business to put more money into the securitization. And that levered up the company, bit of mismanagement, coupled with this problem, and the stock got, crushed, down 90%. what intrigued us was a couple of things. So one, a new management team had come in to run the company that seemed very capable, was doing the right things. The second thing is that Trump was talking about tariffs, auto tariffs. What's interesting about tariffs in the auto industry is you don't charge tariffs on used cars. And so if the price of cars is going to go up by 25% because of tariffs, the residual value of cars is going to go up. So all of a sudden, there are 500,000 cars, the residual value is going to be higher. And so this securitization, which consumed a lot of cash, well, the good news is that when residual values are higher, you can actually take cash out of the securitized portion of the business. And they had worked them through basically the big kind of one-time loss on the Teslas. And our view is they're going to come out of this, start generating more profits. And because this company is so levered, you know, the Hertz stock is almost like an option, like a long-term option on this sort of turnaround. And you're paying $1 billion for the company, and there's like $12 billion of debt against the cars. There's like $4 billion of debt against the company, and the equity reminds me a bit like the General Growth kind of equity. And so we bought 20% of the company. There's a 60% smart shareholder that's trying to fix it. It's for us a relatively small investment. We invested about $230 million, so it's like a 2% or so, a little under a 2% position, but it can be a 7 or 10x over the next 3, 4, 5 years. So, but you can lose your money too, because there's a lot of debt, and the risk is that if in fact the whole tariff thing puts us into a deep dark recession, that's not good for rental cars. So, caveat emptor.
At this point, we've been through my top 10 questions, vetted from the original 90. How about one more question from one of our visitors before we close up shop?
How about the gentleman I met before, the professor of some kind?
Professor of some kind. Economics, finance. Some kind, yes. Some kind. Hugh Kwan, Assistant Professor of Supply Chain Management. Thanks for this opportunity to pick your brains with your insights. As a leader of an organization that deals with tremendous value, high goals, and a multitude of stakeholders, how do you manage internally inside your organization any dissonance, toxicity within your workforce, delegation, and picking your leadership?
Sure. So we have a very unusual investment firm for a number of reasons. So one, we're tiny. So Pershing Square, most firms, we have about 15 billion of under management today, and I think we'll be probably 30 for a couple of initiatives over the next actually relatively short period of time. And we have 41 people, and maybe we'll go to 42 or 43. Most firms that manage similar amounts of capital have much larger firms. So every time you add an incremental person, that's how many, if you think about the kind of matrix, how many interactions they're going to have with other people, each incremental person is a risk. So, smaller organizations have a competitive advantage in dealing with risks. The second thing is everyone at the firm, I interview every employee who joins Pershing Square. And the most important first criterion for selection is this fundamentally a good human being. And if we think the person doesn't meet that standard, we don't care how smart they are, how qualified they are, what they got in their SAT scores, et cetera. So is this someone I want to would enjoy spending time with? And everyone at Pershing Square meets that criteria. And the result is, and then it's, that culture is very appealing. And then we have a business that's extremely profitable. So you can make more money than any other place. We have no tolerance for toxicity of any kind. And people respect each other. The typical reception desk at a firm might have a turnover of, every 2 months there's a new receptionist. We have 2 women who work at reception. They've been with a firm for 6 or 7 years, and we take very good care of them. They take very good care of us. But the fact that there's no turnover at the reception desk tells you something about the culture of the firm. And part of that is that I've always believed, I heard a lot about watches tonight, more than I expected, that the way I describe the company is it's like a watch, okay? And that your experience when you come to the door from the first person you meet affects your entire perception of the firm, and that the firm will not succeed without great women, the 2 women at reception, without Isabel, who cleans the space, without with the accounting team, finance team. Many hedge funds are structured in such a way where the investment team is kind of elevated, and then other people are sort of called like the back office, right? Sort of, it sounds like people that you want to hide. And we're structured in such a way where everyone feels correctly that they can materially contribute to the success of the organization, and they have the opportunity to become a partner in the firm. And the result is, our little firm, we sold a 10% interest in Pershing Square, the management company, last year for $1.05 billion. The firm was valued at, call it $9.5 billion pre-money, and at the time we had $14 billion of fee-paying assets. So about a 65% ratio of the value of the firm relative to the assets. BlackRock is valued at less than 1% of assets. Blackstone, an amazing firm, is valued at 15% of assets. I think the value assigned to Pershing Square was the highest value as a percentage of assets of any firm. And a huge part of that comes from the culture. And so I think culture really matters. Incentives really matter. Another problem with investment firms that have a lot of turnover, hedge funds, for example, people come in, talented investors, and they're hugely incentivized to put an idea in the portfolio, because until they get an idea in the portfolio, they don't get paid, and they get paid a percentage of the profits on that idea. That sounds good in practice, but it can lead to kind of bad behavior, because your worst case scenario if the idea doesn't work is you get fired, and then you go to another firm. In our case, there's no individual P&Ls. Everyone in the firm is compensated based on how the overall portfolio does. So there's no incentive to get your idea in the portfolio. It's as important to reject a bad idea than to get good ideas into the portfolio. And so the combination of those factors, I think, have led to, in terms of how we promote leaders, it sort of just happens naturally. And we don't really need to have a hierarchical organization because of how small we are. So it's very horizontal in terms of the structure. Obviously we have a CFO that leads the accounting and finance operation. We have a chief legal officer that leads the legal team, but it's not like the U.S. military. It's not command and control. It's much more, I would say, partnership and collaboration, and that works very well for our business.
With that, I think you've broken the record for attendance and longevity of speaking. Thank you so much for spending the time and coming down here today. I really appreciate it. Bill, everybody goes home with a bag of swag. So we have a Citadel pullover and a PermCap pullover for you. But thank you again, Bill Ackman.